Steve Rice, Chief Investment Strategist with Standard Chartered Bank, joins us now. Steve, good morning. Thank you for joining us. Steve, the troubles from US seems to be far from over. The city of Detroit has now filed for bankruptcy. Labor market is completely broken down. But if I look at US markets are now sitting at a historic high. How long before this cheap money fuel rally will last?
Well, I don't think it's just money fueled. I think there are some fundamentals out there that are actually quite positive for the US stock market. I mean, obviously earnings remain relatively lackluster, but they are still growing and growing above consensus expectations. So we've had recent positive surprises on that front. And the labour market actually has been strengthening quite significantly. So we're seeing job creation averaging just over 200,000 jobs a month, and that is a lot stronger than last year, which is, if we're looking back at Q4 last year, we're looking around 150,000. We had been expecting 175,000. So overall, we believe that the stock market is likely to continue to perform well. Clearly, there's some concerns over Fed tapering. That may lead to some short-term volatility, but we still believe any volatility is a good opportunity to buy into the US stock market.
So by when do you see an easing of the US Fed's bond buying program? A few regional members do believe that we should see the pedal come off the gas towards the second half.
Yeah, we're a little, obviously the Fed's been talking that until recently with Bernanke sort of highlighting that maybe they could do it as early as September. We've always been saying that the data is not, although it's improving, is not really strong enough at this stage to warrant a move back. And key from our perspective, although the Fed's been very focused on that strong employment data, our focus has been on inflation and inflation expectations. And inflation currently tracking just over 1%, well below the central bank's 2% target. Suggest they still should be patient. So I think what Bernanke was trying to do was float the balloon, saying QE3 is not QE infinity. We will see them move back in terms of tapering at some point. Get the markets prepared for that, so when it actually comes, it won't be a shock.
You are bullish on US markets, but how does the emerging market fit into the investment picture, and which countries are you invested in when it comes to emerging market allocations?
Yes, so in terms of the emerging markets, we're underweight. So we're underweight both Asia, ex-Japan, and also other emerging markets, which are led by countries such as Brazil and Russia. Clearly, we've seen some strong performance coming through in the latter in very recent times. But overall, the picture is, and the key here is China the growth picture is deteriorating. While we're starting to get some sort of concern coming through from the authorities in China, we don't believe that's really at the level yet that will lead to a significant stimulus. And in that environment, we find it difficult to be too bullish on emerging markets at the moment. So our key preference, you asked what's our overweight within EM, we'd prefer to sort of highlight that we do believe that the developed markets are likely to outperform emerging markets by a significant margin. We've already seen that by 20% year to date. We expect that to extend in the next 6 to 12 months.
In India then, Steve, demographics and domestic consumption have been very strong. What sector would you bet on to play on this?
So, the sectors that we like in India at the moment are industrials, information technology and healthcare. By and large, these are very focused on international demand, particularly on the US. And given the US economy is likely to lead any recovery, that should be quite positive. And outside of healthcare, valuations are also fairly cheap as well. So overall, those are the areas within India that we'd be looking at.
How closely are you tracking the political developments in India, and are you also factoring in any kind of an event risk from upcoming elections?
Obviously, elections are always very important events, no matter where you look in the investment world. And clearly in India, that's very key in the short term. However, we generally have a 12-month time horizon, and looking beyond elections, we basically see Indian politics as being stable instability, if you like. So, yes, from time to time you'll get policy and politicians change and parties change, but actually the general tone of policy remains very stable. To some, maybe a little too stable. Maybe we'd certainly like to see more reform going through. But overall, policy is moving gradually in the right direction. We don't expect these elections to change that.
So how are you placed on the cyclicals versus no cyclicals theme? Is there still downside when it comes to cyclicals?
Clearly we've seen cyclicals take a bit of a beating, and that's partly due to the high dividend equity theme that we've seen, which we've been advocating for the last 18 months. So we still believe that high dividend equities are still a key thing that investors want to look for. However, as people become more confident in the economic recovery in the second half of this year, we expect them to start switching into more pro-cyclical areas of the market which have been beaten down and look very cheap from a valuation perspective. So it's one of those strange times actually that you say defensive versus cyclicals, and then you've got value versus growth, and actually the two aren't the same. So we're seeing cyclical as being value at the moment, and that should be very constructive over a 6 to 12 month view.
Well, central bankers in developing countries are struggling with currency depreciation and imported inflation, which can be attributed to dollar strength and loose money supply from US and Japan. Do you see a major risk here, and will emerging market currency depreciation continue?
I think the outlook is that they probably will continue to depreciate in the coming months. We do believe that in a multi-year turnaround in the dollar. So we've had sort of 10 years of dollar weakness. We believe now we're heading into a multi-year period of dollar strength led by fiscal tightening and monetary tightening in the States. And that, we believe, will lead to weakness in Asian currencies and other emerging market currencies as well. We've already seen that come through, obviously, to some extent in Indonesia, but very powerfully in India and in South Africa. Our view is that that's a trend that's likely to continue in the coming months as the dollar bottoms out and starts to appreciate.
Steve, good chatting with you. Really appreciate you taking the time out and joining us today on the show.